putting some money aside every time you get paid. I don't care if it's 1 ounce of silver or as much as you can put into a asset, right? Saving in currency is bad, saving assets good. Whatever assets you can buy every time you get paid will only help you in the future and allow you to get ahead at exorbitant lease rates and whatever 20 or 30 million ounces that got shipped from Comex over there to quell the problem. Well, what good did that do? There's still deliveries next month and the month after and the month after. And
Hmm.
so the physical demand is overwhelming the paper price. And
Andy Schectman, a well-known expert in the precious metals market, highlights a fundamental truth about financial survival in today's unstable economy: saving in assets, not currency. His perspective is simple yet powerful. Every time you get paid, set aside something tangible. Whether it's a single ounce of silver or a small portion of your earnings, investing in real assets builds a foundation of security that paper money can never provide. Schectman warns that saving in currency is a losing game. Inflation and devaluation constantly erode its worth, while assets like silver preserve and even grow your wealth over time. The real opportunity lies in owning something with intrinsic value, something that can't be printed or digitally diluted. He also draws attention to what's happening behind the scenes in the silver market. Despite massive transfers, 20 to 30 million ounces from COMEX to other exchanges, the physical demand continues to overpower the paper market. Month after month, deliveries reveal that the appetite for real metal far exceeds what the digital system can support. The message is clear: protect your future by holding what's real. Silver isn't just a hedge, it's a statement of financial independence in a system built on debt. If you found this valuable, don't forget to like, share, subscribe, and comment below.
And I think it goes to show where silver is ultimately going when the U.S. government has proposed and written into draft, and it will be accepted that silver will become a critical mineral in this country. Things are changing. And
Hmm.
I think what we saw was a desperate attempt by some really caught commercial banks that are massively short, and the rising price, coupled with a government shutdown and trade meetings with Xi and all sorts of stuff going on. The last thing, and interest rates going to be lowered again. The last thing they wanted is for metal to get way out of control, and this is their way to stop it. But I would argue only temporarily, because this is how they have been bleeding down the system for the last 5 years by slowly off taking as much as they could out of London. And that's why London has the lowest float that they've had basically ever since they started keeping records, about 140 or 50 million ounces against 600 million ounces a day in trading. So what could possibly go wrong? And so they are standing for delivery. This is showing the cracks, and that's why we had $3 an ounce backwardation for a while, where the physical metal right now today is worth more than the futures price, and that's very rare in the commodity complex. And they'll buy gold, and I think they'll buy Bitcoin, and they'll buy gold to make it go much higher. They already have over 8 billion worth. They were just at the Beaver Creek Mining Summit. They're going to continue to buy gold to devalue the dollar and to ultimately peg the back end of the treasury market to bring back manufacturing, because we need to. Our children and our grandchildren are dead otherwise
Yeah.
with illiteracy and uneducated masses and a massive spread between the haves and the have-nots and no manufacturing base and massively indebted. We need to do this no matter what. And I think they will do that through devaluing the dollar massively by letting gold go higher. I think they'll let Bitcoin go higher and use it to pay off the debt. This isn't conspiracy. Read the executive order that next year they're talking about revaluing gold as part of the Bitcoin fund that Senator Lummis from Wyoming has been advocating for. And if they do revalue it, it devalues the dollar. It's not about revaluing gold. It's about devaluing the dollar to a much lower level so we can sell our products to the world. You have to bring back manufacturing. How do you do that? You peg gold to the back end of the bond market, and you end up having zero upfront borrowing costs. There's like in the Shawshank Redemption, there's 2 miles of shit that we have to crawl through to get to the other side, like Andy Dufresne did. The exploitation of the delivery option in London and the US is something that was rarely exploited, and now it's being exploited not only by all of the BRICS nations and Russia and China and India and Saudi Arabia and all of the countries that are standing for delivery on all of the world's commodities. But there's someone got to President Trump, in my opinion, and said, if we don't do this, we're dead. We're dead, because they're draining the shelves across the globe. And so they phrase it as tariffs. and they start bringing it back, it's not tariffs, it's reshoring. All the gold and silver, billions and billions and billions and billions and billions of dollars worth of metal. So far this month, which is a non-delivery month in silver, just shy of 8,000 contracts have stood for delivery already at 5,000 ounces apiece. So do the math. I mean, it's not a delivery month, but it's still an awful lot of silver.
The financial landscape is shifting rapidly, and silver is at the center of it. With the U.S. government preparing to classify silver as a critical mineral, the stage is being set for a major revaluation of its role in the economy. This move signals a deeper recognition that silver is more than a commodity. It's a strategic asset vital to national security, technology, and industry. Recent market behavior has revealed how fragile the current system truly is. Major commercial banks, heavily short on silver, have been working to suppress prices amid government shutdowns, trade negotiations, and interest rate cuts. Yet, the fundamentals tell another story. Physical demand far outpaces the paper supply. London's available silver stock has fallen to its lowest levels on record, with just around 140 million ounces backing over 600 million ounces traded daily. Meanwhile, the U.S. and other nations appear to be preparing for a monetary reset by devaluing the dollar and allowing gold, and possibly even Bitcoin to rise. They can restructure massive debt and restore manufacturing competitiveness. The exploitation of physical deliveries by BRICS nations shows that the tide is turning. Real assets are reclaiming their power. Let's get into the interview.
But if they would have said all of those things, market's overbought, gone up for 9 straight weeks, the technicals said this is ripe for a correction, for a flush, for a pullback, whatever validation they want to attach to it, it's invalidated by not saying, by the way, some idiot dumped it in the middle of the night when there was no liquidity in the market and there were no traders, and this is done in the access market. Nobody would do that. They conveniently leave that part out. The other part that they left out was the second day when it was done in between New York and Asia. Again, equally a stupid time to do it. Within just a few minutes, the silver price shot right back up. Well, how the hell did that happen? Well, if you look at Michael Lynch, and he does an amazing job at analyzing the COMEX movements, he says that it was Bank of America and Morgan Stanley that came in and did the purchasing. It was European banks that did the selling, and it's commercial banks, and it was Morgan Stanley that came in and did the buying. Well, why is that valid? Well, the chief investment officer of Morgan Stanley recently came out and said the 60-40 rule of investing that Wall Street's used for, 50 plus years was invalidated now by
60-20-20.
Yes. In other words, sell half your bonds and put 20% into gold. And then that's Morgan Stanley. And then Michael Hartnett, the chief head analyst for Bank of America, says, no, 25, 25, 25, 25. 25 stock, 25 bond, 25 short-term treasuries, 25 gold. And I mean, in my whole career, I've been 35 years, they've never said that at all, ever. Yeah. Maybe 5% they would say. So the two American banks that are saying 20 to 25% allocation come in and do the buying, according to Michael Lynch. And he's got a great Substack. People should check it out. We've now entered a period of time where I think it's all about, an acceleration in a new system that's coming. So I'm concerned that we have hard times ahead of us. And I think what President Trump is trying to do, if there's any nobility in it, is to massively debase the dollar, to devalue it, to ultimately bring back manufacturing and to relinquish, according to Triffin's dilemma, relinquish the reserve standard. If we are the reserve currency, we will never have a manufacturing base. We will always run trade imbalances. I believe they want to get rid of the world reserve currency. They want to bring back manufacturing. And if Judy Shelton is right, and they peg gold to the back end of the treasury market next July, you can bring back with a 20, 30, and 50-year treasury redeemable in gold with zero coupon, no interest in 20 or 30 and 50 years. You can bring back manufacturing immediately with no upfront borrowing costs. And with the passage of the Stablecoin Act, the Genius Act, you look into it and you see that every time money moves, stablecoins will be created. And the interest, because they're backed by U.S. treasuries, the interest that is generated is not transferable. Tether, as an example, USA Tether, by the way, their CEO is Bo Hines, the guy that was Trump's crypto advisor until August. He's now backing the CEO of USA Tether, which is already stablecoin Genius Act compliant. They will back everything with treasuries, which creates synthetic demand for the treasury, pushes rates down, but they will take the excess, the interest between the stable coin and the treasury.
Recent market moves reveal deeper truths that mainstream narratives often avoid. Sharp overnight sell-offs in silver, executed in low liquidity hours between New York and Asia, weren't just coincidences, they were calculated maneuvers. Yet, what's more telling is how quickly the market rebounded. Reports suggest European banks were the sellers, while U.S. giants like Bank of America and Morgan Stanley stepped in as aggressive buyers. This shift in sentiment is reinforced by something unprecedented. Both banks publicly recommending 20 to 25% portfolio allocations to gold, a stunning departure from Wall Street's traditional 5%. It signals a quiet recognition that the old 60-40 investment model is broken and that we're entering a new era where hard assets take center stage. Behind the scenes, discussions about pegging gold to U.S. treasuries, the rise of stablecoin-backed finance, and deliberate dollar devaluation hint at a broader plan to abandon the dollar's reserve currency role, rebuild manufacturing, and reset the global monetary structure. The system is evolving, and those watching closely can see the outlines of a gold-linked, digitally enabled future taking shape. If you found this insight valuable, don't forget to like, share, subscribe, and comment below. Let's continue the conversation.